Today, we will talk about buy the dips. Buy the dips means purchasing an asset after it has dropped in price. The belief here is that the new lower price represents a bargain, as the dip is only a short-term blip and the asset, with time, is likely to bounce back and increase in value. Buy the dips is a common phrase investors and traders hear after an asset has declined in price in the short term. After an asset's price drops from a higher level, some traders and investors view this as an advantageous time to buy or add to an existing position. The concept of buying dips is based on the theory of price waves. When an investor buys an asset after a drop, they are buying at a lower price, hoping to profit if the market rebounds. Buying the dips has several contexts and different odds of working out profitably, depending on the situation. Like all trading strategies, buying the dips does not guarantee profits. An asset can drop for many reasons, including changes to its underlying value. Just because the price is cheaper than before doesn't necessarily mean the asset represents good value. The average investor has very little ability to distinguish between a temporary drop in price and a warning signal that prices are about to go much lower. All trading strategies and investment methodologies should have some form of risk control. When buying an asset after it has fallen, many traders and investors will establish a price for controlling their risk. For example, if a stock falls from $10 to $8, the trader may decide to cut their losses if the stock reaches $7. They are assuming the stock will go higher from $8, which is why they're buying, but they also want to limit their losses if they are wrong and the asset keeps dropping. Consider the 2007 to 2008 financial crisis. During that time, the stocks of many mortgage and financial companies plummeted. Bear Stearns and New Century Mortgage were among the hardest hit. An investor who routinely practiced a buy the dips philosophy would have grabbed up as much of these stocks as possible, assuming prices would eventually revert to pre-dip levels. This, of course, never happened. In contrast, between 2009 and 2020 shares of Apple went from about $3 to more than $120, split adjusted. Buying the dips during that period would have rewarded the investor handsomely. Here are 3 key takeaways. 1. Buying the dips refers to going long an asset or security after its price has experienced a short-term decline, in repeated fashion. 2. Buying the dips can be profitable in long-term uptrends, but unprofitable or tougher during secular downtrends. 3. Dip buying can lower one's average cost of owning a position, but the risk and reward of dip buying should be constantly evaluated. Hope this would help. Thanks for watching.